As the Chief Investment Officer for Private Wealth in the U.S., my comments will be specifically tailored to what's going on in the States. Without a doubt, the question we've been getting most is, how can the stock market be soaring given all that's going on in the world? I'll address the how in a minute, but here you can see what has happened. We had a 34% collapse in the S&P 500 index from mid-February to late March, but it's been followed by a 40% rally from those late March lows. So here's where we actually stand today. On a total return basis, the S&P 500 is down about 4%. And if you look at it over the last 12 months, the stock market is actually up to the tune of about 6%. So as our chart title here suggests, it's almost as if COVID-19 is a distant memory, even though in reality we know it's not. Also, the markets really did not react at all to the nationwide protests in the aftermath of George Floyd's death. But they've obviously been reacting positively to something. And I think it's actually really three things. First, as we moved from March to April to May, there was more clarity and overall better news on COVID-19 in terms of case count, hospitalizations, and deaths. Now, some parts of the country are seeing upticks in cases in recent weeks, but hospitalizations continue to decline. But overall, that has moved to a path of more certainty, at least in the market's perception. Second, we've seen massive support of the economy and markets by the federal government. And this not only put a floor under the valuation of risk assets, it actually incentivized risk-taking. So for equity investors, we've seen the ultimate application of that old adage, don't fight the Federal Reserve. And third, importantly, there's mounting evidence that the economy has already hit rock bottom and actually began to recover in May. The economy actually added jobs back in May, and I know there was a similar result in Canada, and retail sales rose 17% in May from April. So I think we're learning that in this unique shutdown of the economy environment, a little reopening goes a long way. So as we look at our investment themes, the good news is the economic recovery has begun, and it's ahead of schedule. I think the more challenging news is that we dug a very deep economic ditch very quickly, and it will probably be a long road back to recovery. The hope, of course, is for a V-shaped recovery. In other words, that we recover as quickly as we went into recession. More likely, though, a full recovery will take years. Our work suggests that it could take well into 2022 before we recover all of the lost economic activity caused by the COVID-19 shutdown. We're watching China as a potential leading indicator on the economy, given that it went through the COVID-19 shutdown and came out of it 2 months before us. So far, what we've seen there is that production levels in the economy have been nearly fully restored, but the consumer has remained rather cautious. We have seen the Federal Reserve go all in with monetary stimulus, along with many other central banks. They've driven short-term interest rates to zero. They're doing massive bond buying to suppress longer-term rates, and they've instituted 9 different programs to support the credit markets. We estimate the overall impact of what the Fed is doing at 3 times their impact during the great financial crisis just over a decade ago. It's been remarkable. And it has very quickly stabilized credit markets, and that was really a necessary condition before the stock market could advance. Meanwhile, elected Washington has put several $1 trillion into the pockets of households and businesses. This income support, I think, is one of the reasons that the economic recovery looks to be a bit ahead of schedule. Now, parts of that program expire at the end of June, and then other parts expire at the end of July. My thinking there is it's an election year, so that means there will probably be another fiscal support package and probably north of $1 trillion that will be passed in July to kind of keep the money flowing in what is still a very fragile economy. In terms of what all this means for the interest rate outlook, at its most recent policy meeting, the Fed projected that short-term interest rates would remain at essentially zero through the end of 2022, so that's another 2.5 years. We could see a slight increase in longer-term bond yields in the maybe 0.25% to 0.5% range over the next several months, but of course that would still leave interest rates across the yield curve way below historical averages. In terms of the stock market, as our first chart showed, we have seen kind of a V-shape to this equity market cycle. We think that's nearing its end, and that what we're going to see over the course of the year is more likely a volatile trading range, a sort of a directionless trading range that bounces up and down. Part of that is obviously the incredible extent of the recovery that's already occurred, that 40% rise we talked about. Valuations are a bit on the high side, and in general, it seems like market sentiment has moved from a worrying about all that could go wrong to focusing on that all that could go right, and of course reality is likely to be somewhere in between. And just to make the second half of the year all the more interesting, the presidential election has been much more off the radar screen than it normally would be, of course, due to COVID-19, but that's bound to change, right? We're going to go into the second half of the year, get closer and closer to November, and investors are going to do more thinking about the likely election outcome, who will be elected president, who will control the Congress, and what that might mean for market impactful policy in 2020. So it's bound to have an impact. We also approach that issue with the knowledge that positioning around election outcomes can be a very dangerous thing for an investor, as Americans learned in 2016.